Greetings and welcome to Seminar Saturdays. This week we're talking about government procurement. Our week's paper is called Government Arrears and Corporate Decisions, Lessons from a Natural Experiment. And like usual, I'll apologize in advance for mangling names. Our authors of this paper are Jose Abad, Vicente Bermejo, Vicente Cunat, and Rafael Zambrana. I'm sure I messed up at least one person's name, if not all of them. And this is a working paper that was presented at the American Finance Association in 2025, so just a few weeks ago. So a few introductory notes. I was at the presentation. I was at AFA, and this is one of the papers I saw. I thought it was quite interesting, and that is why I picked it for our Seminar Saturdays. Because it's a working paper, no guarantee it's getting published, even though it was accepted at a top conference. And that also means it's typically less refined than a published paper like we've seen in the past few weeks. And a question here about a government procurement, it's less core to what finance is all about, but it's still a fun topic to me. And there's some implications for trade credit, because that's super common in business-to-business transactions, that possibly would extend beyond government-to-business transactions. So, should governments pay their bills on time? Well, yes, they should, but this paper is about what happens if they don't pay their bills on time. And this is interesting. After all, it can be a little bit awkward to take the government to court over not paying their bills because the government is also the court. So how do companies respond when a very important, powerful, and unique customer, governments, don't pay up when they're supposed to? And the authors have a pretty good and, in my opinion, amusing natural experiment to explore this question. So they start in their first paragraph of the introduction by emphasizing the economic magnitude of government procurement. And by procurement, they mean the government is purchasing stuff as opposed to, I assume, transfer payments. So a Social Security check that grandma gets is not procurement, even though it is government spending money. And they say it's 13 to 20% of global GDP, $9.5 trillion a year. They're trying to emphasize the importance of the topic as a way to improve what their contribution is to our knowledge of important things, because it's an important topic. This is a very common tactic for papers to try and emphasize why the thing we're interested in, or the thing the paper wants you to be interested in, is important. That's why you should be interested. There's a lot of money involved. So, some predictions that they're going to be looking at. Now, governments defaulting doesn't happen very often, but they sometimes or often don't pay their bills on time. Now, in theory, if we don't have transaction costs, we don't have any market frictions, the companies could borrow against the late bills. Since default is rare, they'd be able to do this. But transaction costs always actually exist in the real world, and so we don't know how harmful it is for the firms to have late government payments versus payments on time. And if we know how costly it is here, we might know how costly it is for late payments from any customer, although the authors don't really focus too much on trade credit overall in their paper. But, like always, there are endogeneity issues. So suppose we think that the arrears, the late payments, because of market frictions, are reducing the company's ability to invest. There's cash they should have gotten and they're not getting, and they can't borrow against the accounts receivable that they have with the government because of market friction, so they have less money they can use to reinvest. But why is the government paying late? Perhaps it's because of a negative economic shock, some sort of recession. So is our company investing less because of the late payments, or is it because of the recession that's causing the late payments? To get around this problem, What you want is a random increase or decrease in the government arrears to get that causality. Fortunately for us, the Spanish government did something stupid. Or, maybe they're just being really helpful and giving us finance researchers a great natural experiment. It's probably because they were forgetful. So, our setting is in Spain, and the Spanish municipal and regional governments were under a lot of financial stress following the 2008 financial crisis. Also, the Spanish national government was under a lot of stress in those years too. If you may perhaps remember, the pigs in Europe, Portugal, Ireland, Italy, Greece, and Spain, there was a debt crisis where, the national governments were having a difficult time borrowing. But according to the authors, the municipal and regional governments of Spain had some issues too. And so one thing they did, which is something we say that companies might start doing if they're under pressure as well, is they started paying their bills later. So trade credit use peaked, and arrears on their trade credit also peaked in 2011. So before the national government stepped in to attempt to solve the problem, 35% of the municipal outstanding trade credit was at least 12 months late. 16% 2 years late, 9% over 3 years late. So there was a lot of trade credit that they had extended way past the due date. And Spain, the national government, probably in response to a European Union directive that they needed to deal with this problem, passed legislation that provided funding for the arrears. It's kind of complicated, but basically the national government borrows some money from major banks. They pay off the local government debt. So now the local governments owe debt to the national government, and companies with the arrears receive the promised cash, thanks to basically the bailout of the municipal governments. So now they get their cash. But a specific type of municipal government, mancomunidades, I'm not going to try to pronounce that ever again, was not included in the legislation that created the transfer of debt. So companies that had arrears from that type of municipal did not get cash in 2012 because the Spanish legislature forgot about them. In 2013, there was new legislation passed that added this additional type of municipal government. So if you had arrears with that type, you eventually get your cash, but it's a year later. So authors are careful to note, there's nothing unusual about this type of municipal versus other municipal governments, and that the Spanish legislature excluded them by accident, which is kind of obvious given that they quickly put them back in the next year, and that companies that do business with both types are not that different either. So the reason they're doing that is because they need to convince us that this was a random difference. Wasn't there something unusual about this type of municipal government in terms of their types of businesses they operate with, or their political connections, or whatnot? It was just a dumb mistake by the legislature. The ideal case for them would be, for instance, my hometown is the city of Naperville. There's also the village of Lisle, just next to my hometown. And if there was some legislation that affects cities but doesn't affect villages by mistake, there's no real difference between those two suburbs beyond the legal title. That's the ideal that they're going for. And I'm not very familiar with how Spanish regional and municipal governments work, so I don't know for sure if they're right about this or not. So they plan to compare the first wave of companies that received the cash in 2012 versus the accidentally excluded companies. So there's a big decrease in arrears for those first wave companies, and nothing happens for the excluded ones. And then they can also possibly come in and say, well, all right, now we have the excluded ones in 2013 and compare those to the first wave, although they mostly just look at the first wave. And this is hopefully a random decrease in arrears for some companies versus other companies that don't see a decrease in their arrears. And both companies are vendors for local governments. Both companies have lots of arrears. And then the difference in how they respond is, again, we think, if we believe this identification strategy, caused by the change in their arrears. So if I were a journal editor, ideally I'd get a referee with a background in Spain. Someone who's familiar with how local governments work in Spain, because this is really key to their identification, is that this one type of municipal company or municipal government is similar to the other governments. The companies who contract with those different types of municipal governments are usually similar. You kind of want that background because you want to be confident that the strategy is actually working. Okay, so what is their data? Well, because it's not in the United States, the data is unusual. So they have information on the unpaid bills, the arrears, from the municipal governments and which phase the companies pay off, get paid from a government agency in Spain. They get firm financial data from Iberian balance sheet analysis system. It appears that it includes private firms as well as publicly traded corporations. So they have much smaller companies included in their data set than we typically see. They have procurement contract details, which they use at the very end through open tender. And then municipal accounting information, business factoring and turnover from other Spanish government sources, and then media attention through Factiva, which I am familiar with at Factiva because that's one that is often used, but the rest are all pretty specific to Spain or the European Union. Okay, so the first thing they do is they compare phase 1 and phase 2 firms. Phase 1 firms, you recall, are the ones who receive their money in 2012. Phase 2 are the ones who get it in 2013. So they're first compare them in panel A, just not matching. And there's no, these are just the raw samples. And various things like firm characteristics like debt, cash, so on. Ideally, again, these are not going to be that different from each other because we want these firms to look similar before the shock. And then they use a matched sample with the panel B. And again, this is to try and make the firms more similar to each other using this matching procedure on their total assets, on how much of the repayment shock they get, and where the firm is located. And it does appear as though the p-values go up, meaning there's less differences between them when they match. Most of their actual regressions that they run, they use the matched sample, not an unmatched sample. So, when they set up the regression, they are taking those phase 1 firms that receive repayment in 2012, and they sort them into 4 buckets based on the relative size of arrears that were paid off. Less than 1%, 1 to 5%, 5 to 10%, or 10% or higher of their total assets. The idea being that the bigger their arrears are relative to the company's size means there's going to be a bigger reaction. Now, if you have a tiny fraction of your company that you receive in extra cash, maybe you don't react at all. If you receive a huge amount of cash relative to your size, then maybe you react much more strongly. And so what they're predicting or thinking that will change is investments, cash holdings, and debt. If they were borrowing against arrears, now they don't need to do that anymore, so their debt goes down. They have extra cash, so cash goes up. And they have extra cash, so investment can go up too. All right, so their main results here, they have the unmatched sample in panel A, the matched sample in panel B, and they're looking at investment, leverage, and liquidity, which is cash. So investment goes up, and pretty consistently up regardless of what sort of control variables they're using. Leverage, no change. And then cash, it is extremely weak. It goes away in the matched sample, and statistical significance here is 1.645 is roughly where you'd be at for 10%, so they're just barely above that. not very strong result there. So they're not really finding huge results in the overall sample beyond investment. The next thing they do is they focus on investment and they split them into their buckets. And this is using the match sample. What they find is there's still some effect when it's less than 1% of the total assets, but the effect is much stronger as it increases. So at the 10% or higher subsample, the phase 1 firms have a much stronger increase in investments, and the statistical significance is that it's above the 1% value for p values. It's much stronger effect as the relative size of the arrears increases, which we would expect that. And because this worked for them, they probably also try leverage. And it turns out, actually, they do see some change in leverage with statistical significance, but only if they limit it to the largest size effect for the firms. So it didn't show up in the main sample, but if you limit it to the things we think should be the most strongly affected, they do seem to decrease debt. And they see a similar pattern with liquidity for the ones that are very strongly impacted by the change in arrears. There's an actual effect that shows up for those companies. So again, cash increases. It was extremely weak in the main sample, but when you separate out 10% or higher, suddenly it is very, very strong. Okay, so the next two tables are robustness tests with similar patterns. I'm not going to go over those. The authors say they have strong results, that investment increases, that leverage decreases, that cash increases. I can buy the investments part being strong, but cash and leverage, they were barely there with the main results. It's only when they split on those subsamples for 10% or higher of total assets that they actually saw something. So it's not quite as convincing for cash and especially leverage. So if I were to put on my referee hat, first of all, strong is too strong. Tone it down, especially for cash and leverage. Just the language itself is too confident. And then you're splitting these guys into groups of 4, right? And 10% is and above. Well, what happens if you do 9%? What happens if you do 8%? If you split it into thirds, so it's 5% and higher versus less than 5%, what happens with slicing it into different subsections here? Because there's no real good theoretical reason for why they should split it into 4 pieces, or why 10% is the right cutoff. As far as I can tell, there's not really any discussion of that in the paper. And that's always kind of worrisome. P-hacking, red flag. Or is it really robust to shifting around that particular level? It looks like if between 5% and 10%, they're seeing some results too. So it's probably robust, but referee's probably going to want to see that. Next thing they look at is financing frictions. So if our firm had an easier time borrowing its arrears, this fixing of the arrears, this cash influx, is going to impact them less because you had less frictions in the financial markets, and so the harm that the arrears was imposing on you is smaller, and so the removal of that harm is therefore less impactful. So what they look at is if the firm has a loan with a top bank, and if you have a lending relationship with a top bank, then you are considered to be less constrained. And this has some reasonable basis here. So there's plenty of papers that have found banks tend to be more willing to make deals and better deals with firms that they have a prior lending relationship with. And there's a number of explanations. One very obvious one is if you've already made a loan once with this company, you probably know more about it. And so as a bank, the amount of risk you're taking on by making a new deal is lower than if it's a de novo company you've never had experience with. Also, this is Spain in Europe. And Europe tends to have more bank lending as a source of financing for companies than American companies, at least for publicly traded companies. Now, this is mostly private companies in their sample, so maybe that's less impactful. According to their paper, factoring accounts payable of a regional or municipal government was not considered safe lending by European Union regulators. That would make banks less willing to take on this factoring. And so a bank that's more sophisticated or in a stronger position would be better able to make a factoring deal versus ones that aren't. So again, that does point towards having access to a strong, sophisticated bank being something that would allow you to factor these arrears, borrow against those arrears, versus not being able to. Now, how do they define top bank? So what they do is they look at the core equity tier 1 capital ratio, and if it's above 7.4%, then you're considered a top bank. So 7.4% was the average ratio for the Spanish banking sector. Pretty likely that if you're a Spanish firm, you're only going to be working with other Spanish banks. So there's at least some theoretical reason here for picking 7.4%. It's the average. I'm going to put on my referee hat a little bit again. So if you have a high capital ratio, that means your bank is safer. There's more safe assets that they are using versus risky assets. But does that also mean that they're bigger and more sophisticated? Because just because your bank is safe doesn't mean it's a very sophisticated and big bank. It could just be a small bank that's very conservatively run. The answer is probably yes. But some confirmation would be nice. And also most countries, I'm pretty sure Spain is like this too, have several really large banks that are kind of disproportionately impactful for the whole banking industry. Like the United States has a couple of really big banks, JP Morgan, Wells Fargo. There's 4, right? And Spain has a couple of large banks like that too. I wonder if you have a relationship with one of those really big banks, do they still find what they find using this capital ratio? And since factoring is considered risky, if they have a high ratio, that means more room to do factor lending. They don't really come out and say it as far as I can tell, but that's probably a good reason why you pick capital ratio versus picking a big sophisticated bank. But that is sort of their logic there. And indeed, there was a lot of factoring going on. Everyone's factoring went up a lot. Like 2011 is right here. So factoring was shooting up post 2008, especially from 2010 through 2011. And indeed, what they call top banks seems to have more factoring than non-top banks, although everyone is doing lots of factoring, which I'm sure every company that had these super late arrears was trying to find ways to get cash from their accounts receivable because they're a year late, 2 years late, and that's, at that point you're probably expecting to never get cash. So when they do this, they split the triangulation again using just less than 1% versus 10% or higher. Not really sure why they did that, although of course they're expecting to find things at the 10% and higher arrears versus the 1% and lower. So they look at investment in panel A, leverage growth in panel B, and liquidity growth in panel C. And so what they find is that for guys that had the top bank, nothing really changed with investment. If you looked at people who didn't have a prior lending relationship with a top bank, the people that had less than 1% still saw no increase in investment, but if you had a big impact from arrears, you had a big increase of investment. They looked at leverage growth. It appears leverage growth declines regardless of your relationship with a top bank. And it's a little bit bigger if you do have a top bank. I'm not sure if that is actually statistically significant. There's ways to do it, but authors didn't do that here. But if true, it would point a little bit towards they were factoring more when you had a top bank you can factor with. And so once you get the cash, you're able to pay down your debt more because you were taking on more debt in the first place. So that would be why there's a bigger decrease in leverage for the ones that had a top bank relationship. And then cash, both of them are increasing cash. And as far as I know, there's no clear conclusion the paper offers here about the differences. They also look at long-term debt, so financial debt, and accounts payable, so short-term debt, because they think there might be some changes with how companies respond depending on their bank relationship. So what they find is long-term debt for the strongly affected companies goes down if they have a banking relationship, and it's short-term debt that goes down if you don't have the banking relationship. So what this suggests is that the top bank firms were factoring, and they were getting longer-term debt through their factoring. And so when they started paying it down because they received the cash they needed, they then pay down their long-term debt. The firms that didn't have long-term debt, because they weren't able to factor, because they didn't have a top bank, they were increasing debt still, but they were doing it with short-term debt, accounts payable, which is basically their own trade credit. That's one of the main sources of accounts payable. So they were putting their own trade credit maybe in arrears or just extending it out as much as they could. And so they stopped doing that once they get the cash that they were owed. Which this one is an interesting implication here because it sort of implies that if the government procurement is late in arrears, it's going to have knock-on effects on trade credit from business to business transactions because it's going to harm the guys who do business with the government, and then they're going to extend their trade credit with their vendors, and it's just going to cause additional problems beyond the negative impact on the companies who directly deal with the government. And then the last thing they look at is future government procurement. So going forward, following this big problem and then the fix by the national government, did the firms that were burned by this arrears treat procurement differently? And they're using the procurement data from open tender here. So did they withdraw from procurement overall? So did they just were they just knocked out of this business, or did they stop selling goods and services to municipal governments? Or did they withdraw from just the specific ones that were bad actors and didn't pay their bills on time? Well, they look at arrears post 2012. So this is after, post 2011, which is the last year before the shift here. And in terms of new contracts, they are doing fewer new contracts. The price, the value of the contract is lower. And these are for the bad actors, column 2 and column 4. So they were shifting away from the municipal governments that weren't paying their bills. But their participation overall didn't really change. So there's negative signs here, but it's not statistically significant. So these companies are still doing business with the municipal governments providing goods and services, but they are not doing as much business with the municipals that were failing to pay their bills on time. And the reason for that is basically this switching to year and firm fixed effects in column 2 and column 4 allows us to look at just the municipals that were late in arrears. So interesting result there. That's kind of more another kind of interesting finding from them. They were able to shift away from particular municipals, but they stayed in the market overall. So it doesn't seem like they were forced into bankruptcy, forced out of the market completely. They're still able to keep operating. They just were able to make that strategic shift of, we don't trust you anymore because you didn't pay your bills on time for the past 3 years. We're going to not do as much business with you going forward. And that's pretty much the entire paper. So firms were affected by these arrears, as we kind of would expect. The strongest sort of impact was investment. They find some evidence that the cash and leverage of the firms is also impacted by this decrease in arrears, but the results there are a bit weaker. Again, we don't know how sensitive they are to the sort of the size of the arrears relative to company size. And there's some interesting results with banking relationships here that might have mitigated harm from arrears if you had a bank that you were able to work with. And it seems like it didn't force the companies out of the market completely, but they did shift away from the bad customers. So if you were a municipal government and you were abusing these arrears to delay your payments, you're probably going to have a harder time finding people to work with you in the future because you've kind of burned your bridges there. Now, results in this paper are kind of weak. I've already noted it for cash and leverage. And it was, this hasn't been published yet. I'm not sure where it will get published. I suspect that the weak statistical significance for cash and leverage is going to be a problem for this paper. I'm not entirely sure if it'll publish. I wish the authors the best of luck, but I suspect at top journals that the weak results for cash and leverage are going to cause them problems. Hopefully it was interesting to read about for you as well. I enjoyed reading the paper as well as listening to the presentation and the discussion afterwards at the conference. And next week, we're going to be covering social networks. So see you next Saturday.